Welcome to Early Edge Club. Before we deep dive, we are opening Early Edge Club to a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. You will be surrounded by thoughtful, like-minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
Cosmo First Ltd. It is engaged in specialty films for packaging, lamination, and labeling applications. Its offerings include BOPP films, cast polypropylene films, and soon to be offered BOPET films. So the company was established in 1981 and is a pioneer of BOPP films in India and leading specialty films player. It is also the leading BOPP and specialty films exporter from India. It is world's largest producer of thermal lamination films, globally second largest player in specialty label films, and world's largest supplier of industrial application films. Regarding their unique proposition, they have a strong blend of specialty and semi-specialty and commodity films, and they're globally among top 4 in BOPP specialty films. And they're said to be India's largest BOPP producer based on the current CapEx which they have done. Now, their production facilities is as follows. For BOPP, they are around 200,000 million tons. For thermal, they are around 26,000 tons. BOPT around 30,000. Coated specialty films around 6,000. Metallized films around 40,000. CPP films around 30,000. And capacity utilization films around 700 million tons. They are diversified into multiple segments which are related, which is specialty chemicals, rigid packaging, and sun control films, which is expected to launch from fiscal 26 onwards, which is this year. And they've also ventured into Petcare, which is a bit off from their current business segment. So they feel that this Petcare segment is unexplored and has a lot of growth potential. So they have omni-channel business model there with service focused to address pet needs at every stage of their life. And they're planning to build India's largest pet care ecosystem with presence across experience centers, online and mobile vans. And they're strongly focused on research and development and have got a very good ESG rating from CareEdge. This represents their product portfolio. They are into packaging films, lamination films, label films, and industrial films. Their customers include many top global and FMCG brands, which starting with ITC, Nestle, McDonald's to P&G, Pepsi, Colpal, Unilever. So they're serving a broad range of MNC clients. These are their board of directors. All of them are very experienced, and there are a large number of independent directors. And their executive directors are also highly qualified in terms of ESG and other industry parameters. So it seems good. And they've got a good leadership team starting with the CEO and CFO. Regarding the industry dynamics, globally, they feel that the BOPP demand is estimated to be approximately 9 plus million ton per annum. And it's highly increasing. And they expect strong domestic and global demand in helping efficient capital capacity utilization of their systems. The company's future CapEx strategies align with targets to increase the specialty segment and reduce cost of production, and they're further expanding into BOPP and CPP capacity by putting the world's largest lines in the form of their CapEx. Also, they have related diversifications to different segments, which we already mentioned. Moving forward, these are their specialty and semi-specialty growth margins, where they're expanding this segment highly because they think it's a high margin category, and they have a 10% CAG of over the last 6 years, which seems good. So they are highly optimistic about this segment. Now, regarding the focus, their movement to specialty brings stability in margins and is a high margin business, which helps them significantly. And they think that they will experience complement growth in also the BOPT line, which involves shrink labels, heat reduction films, and other high end specialty items. And they're targeting 20% ROCE in medium to long term. And they're investing heavily on R&D and sustainability in this segment. Now, the growth areas in this segment includes synthetic papers, direct thermal printable films, and system PVC-free solutions for graphic applications, and also heat reduction films and paint protection films, which is a new segment in their business. Regarding the global market size, they're expecting it around to be 5.4 billion US dollars, and it is expected to grow at a 5% CAGR. So this increasing demand would help them capture a significant market share and grow rapidly. So there they have made a lot of innovative product launches recently, starting from Cosmo First window films to transparent CPP films, graphic films, PVC free to puncture resistant barrier metallized CPP films and other amongst other products. And they credit it highly to their R&D, which is going significantly well. They have R&D labs with most sophisticated equipment and instruments, one in India and another one in USA. And R&D resources increased to 30 plus in the last 2 years, and R&D spends is about 0.5% of annual revenue. So they're investing heavily in R&D. Now comes to their business segments. Rigid packaging domestic industry size is of around 10,000 CR in Indian rupees, and it's growing at 10% plus of CAGR. And they think that this their state of the art machinery and R&D team makes their product moisture resistant, tamper proof, and gives excellent clarity. And they've also got food safety certifications, which makes them a prominent player in this segment. Also, they're into specialty chemicals business. There they have three subsegments, which includes master batches having a capacity of 10,000 million tons, adhesives having a capacity of 2,500 million tons, and coating chemicals having a capacity of 5,000 million tons. And they expect that all this industry is going to grow at a very significant pace. Master batches are expected to grow at 11% per annum. Adhesives are expected to grow at 8 to 10% India and 5% globally. And coating chemicals are expected to grow at 8% CAGR annually. Regarding the new segment, which is Cosmo Sunshine and Cosmo PPF. So Cosmo Sunshine expected to grow at 8% per annum, and Cosmo PPF, which is paint protection films, is expected to grow at 10% year on year. Now, this forms a significant part of our presentation. The new D2C Petcare brand, which is a bit pivot from their present business. Now, they expect that the Petcare industry is booming with 25% annual growth rate and 35 million mega million pets and one annual adoptions. So they think that this industry is going to grow really well, and it's highly unorganized. So if they crack the D2C code and organize it, then they can generate significant revenues from it. This is their business model. They have a gross merchandise value of 15 crores in Q4 2025, and they have served around 60,000 customers last year with 7,100 plus SKUs and 35% repeat customers. So they have launched the first Petcare app, and they have a customer database of around 6 lakhs and social media following of around 210,000. So their business model is broken down into multiple segments, starting from retail outlets to own e-commerce website and app, service marketplace, and other marketplace where they launch their private labels like Amazon, Flipkart, and Qcom. They also have got a grooming brand in Delhi. So they're expecting to grow at a 25% growth rate for India, but the company's focus is more on services than products, and average spending pets increases significantly. So this can generate them a recurring revenue through their omni-channel business. But they plan to demerge Petcare vertical from the Cosmo First into a separate company in medium term. So that's need to be looked into. Their annual year-to-date performance is as follows. We can see that they have made a significant margin improvement in terms of their EBITDA as compared to last year, and they have brought it close to previous levels. However, it's lower than fiscal year 2023 and 2022's performance. Their PAT has improved, but as compared to last year, but it's still significantly less as compared to the subsequent 3 years. So we need to focus on how the company plans their future growth, because the financial performance is not that great year on year. Some of key financial snapshots in the debt to equity ratio. It's mentioned that debt to equity is 0.7 times as of March 2025. But as per our records, it's actually 1. So that's a bit concerning. But the company has been growing their net worth and book value per share significantly over the past few years. Regarding the quarter 4 performance, quarter 4 of this year was really good as compared to last year and as compared to previous year Q4. So that's nice. And the company said that the EBITDA would have been better this year, but they had a one-time non-recurring cost of 4.3 crores for thermal line shifting from Korea to India, which brought in around 10 crores in annual efficiency and 10% lower volume for BOPP films due to planned shutdown. So this is going to benefit them in the future, but it reduced their EBITDA this year. The management has given a strategic perspective on their business, which said that with the new BOPP line coming in half one of fiscal 2026, the company's BOPP capacity will increase by 40%, and this will enable them to become a leading India, one of the lowest cost of productions with new capacity. And they're expanding specialty portfolio, R&D focus, and their current patents, which is 5 and another 12 which are in pipeline, is going to help them significantly. And the company is expecting a CAGR growth of 20% top line in the next 3 years, and potentially high growth engines in this segments is going to help them. And they feel that they have strong financials, which is not quite true, but it can be in the upcoming years. And they have got AA minus credit rating with a stable outlook by CRISIL. So they have broken down the segments in terms of the strategic perspective. The specialty chemicals in the master batch, they have 75% captive consumption and 25% outside sales. They have a good EBITDA here, and they have a few new product launches which is expected to drive growth. In the Petcare, already discussed previously. In the rigid chemicals, they have got the certification. The industry is growing highly, and they're focusing on direct tie-ups with the brands to enable growth. Now, regarding the bull case, it's the BOPP films in India and leading specialty films player. So that's a thing, and they're expanding the high margin business, which is the specialty films part, and they've done heavy capex in multiple segments. And the management has given a guidance that this will yield a significant ramp up in revenue as well as profitability in the next 2 to 3 years. And their R&D and sustainability focus and the patents is going to give them good yields. Their case is as follows. They are susceptible to volatility in raw material cost and demand supply dynamics. And they also face execution and operational risk because a lot of capex has already been built in the books, but then is expected to arise in the upcoming years. So that needs to be monitored closely. And their financial performance as of last year, fiscal 25, has improved since the previous year, but it's not very good on a long-term historical basis. Coming to their 20-factor scorecard, they came up with the 1995. They don't have any other fundraise history, so give them a 5-year. Their promoter holding is not very stringent, and they have a clean track record, so give them a 5-year. They have very minor transactions with related parties, so they got a 5-year. They have got good board independence. 70% of the directors is independent directors with no family on board. That's very good. And salary as a percentage of revenue is also low. There has been certain resignations. The director is in 2012 and then again 2014. That's in the long time history. And their vice president of taxation and corporate affairs is in 2025 due to personal reasons. That's not very concerning. So they got a 5-year. Auditor had the tenure till this year. We do not have any information regarding the reappointment. Auditor opinion has been unmodified over the years. CRISIL had a stable long-term and short-term rating over the past 3 years with a AA minus in long-term and A1 plus in short-term. And regarding the regulatory issue, in 2023, they reported payment fraud incident in a Netherlands unit with amount involving around 1 million euros. That's not a fraud that they have done, but they have experienced this and they have made an immediate complaint at the police station. So that needs to be checked whether how much it affected their business there. And they have all the disclosures and communications available. So give them 5 years as well. Coming to their section 2, financial health, they've got large MNCs as their clients. They've got a large product portfolio and are into varied segments. So they have good business diversification. So give them a 5 year. Their revenue year-on-year growth is just 12% and they had a negative 16% growth last year. That's a bit concerning. But the management has given a guidance of around 3,500 to 4,000 crores in fiscal year 2026. That's a good upward move from the current revenue, which is around 2,800 crores right now. Receivables has grown significantly over time as compared to the revenue, and it's now come up to 10.8% of. So I gave them a 0 here since the revenue growth projections are not that. Their operating cash flows as a percentage of EBITDA is decent. This year it came down to 46% due to high inventory and reduced payables. However, it has been good historically with an average of 76%. So I give them a 5 year. Their inventory days are a bit high. Their DSO is still stable. So give them a 3 year. Their cash conversion cycle is very low due to the high payable days right presently. So give them a 5 year. Their CapEx as a percentage of revenue is 17.3%. So we can say that they're doing heavy CapEx, which we already saw of 1,180 crores. And their asset turnover is 0.8 right now. But asked a question in a con call, and the management said that asset turnover is expected between 3,000 to 4,000 crores sales, and a year after year to 10 to 15% jump expecting. So the asset turnover will come into place, and they have a return on invested capital of around 12% presently. It has declined, but it's still okay. So give them a 3 year. Regarding the debt, they're highly leveraged. They have a debt to equity of 1 and interest coverage of 2.6. The management gave a guidance that they would do major debt reduction from next year onwards, that's in 2027. And this year, most part of the debt related to growth is already built in their balance sheet, but returns are yet to kick in out of majority of the CapEx. So that's something we should monitor. And the quick is 0.3 and current 0.8. So they don't need that much cash to operate. As we can see historically, also they did not have that much cash, but still gave them a 3 year because they lack good liquidity. The return on equity, return on capital employed, and return on asset metrics are not that superficial, but they're in the average. So I give them a 3 year. The revenue growth is just of 7%, and their PAT growth is around 25% on average. This year they made a significant improvement in PAT, but in the past 3 years, when we see their PAT declined for 2 years continuously since 2022. But the management says they're expecting good results in 2026 and 2027. So overall, their scores comes up to 50 for governance and promoter behavior and 33 for financial health. So their final score comes up to 83 out of 100.
So let me
That's all.
look into the valuation part of it and a few thoughts. One is the diversification into other unrelated line of business.
I think is a bit concerned. Like, why do they need to do that? Can't they just focus on the
Yes.
present business?
Diversification or diversification is the question. But anyway, like they are highly taken leveraged as well. One thing I would like to highlight is that we please get deeper. I think they have raised capital, or is it something else? Like the equity capital has increased. Can you see here? So from 18 to 26.
Yeah, I saw it here. I checked in their annual reports, but I did not find anything that they mentioned. They mentioned that they have not raised any funds.
Stock split then?
Maybe they have increased their authorized capital or something like that.
Okay, that is something we need to
Because
check.
most of the
Okay. So since the March quarter numbers, the stock has rallied. Regarding the valuation, you are saying that they are expecting 10 to 15% growth year on year.
yeah. No, they're expecting to do 3,500 to 4,000 this year, and next year onwards, they are expecting to 10 to 15% year-on-year growth.
Okay, so this year they are expecting to do 3,500 to 4,000.
3,500 to 4,000.
That is interesting. And what about the operating margin?
Margins, they haven't said anything about that, but
Okay.
yeah.
So let us
They are
take the best
expecting
case
to
scenario.
improve the EBITDA because last year the EBITDA was lesser because of some non-recurring costs.
Okay. So based on that and giving a 15 PE, the target price is 1,500. But again, this is still lower than what the management expects. So let's try increasing the margins to 15 to normalize that. And if you do that, the target price is 1,870. It's currently at 1,170. So looks if the management executes what they say, there could be potential for re-rating. And I think that is why you could see the spike right after the March quarter numbers. It has been reflected here. Once the next quarter number comes, and I think that the market will track the progress and then maybe re-rate accordingly. Since they have done aggressive capex, their free cash flow is negative going forward. That should normalize. Let's try taking the profit after tax number 133 and minimum required return of 20 and terminal rate of 3 and our target 5 years period and a terminal multiple of 15. And if you calculate, the implied growth rate has to be 23% minimum. So next year they will do good jump, but after that they are expecting 10 to 15 numbers, so 10 to 15% growth. It looks like on an overall normalized basis with the current trend and management guidance, a 20% CAGR looks likely, but then debt is a big issue and multiple unrelated diversified business. So you need to track multiple lines of businesses. So let's see. I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research plus cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye-bye.